Meantime, some newly released minutes from last month's Federal Reserve meeting showing officials strongly inclined to lower interest rates, with the only dispute seeming to be over how many cuts were coming this year. That's 2 or potentially as many as 3. The Fed deciding on September 17th to lower interest rates by 25 basis points. Joining us right now to talk treasuries and rates is Komal Sri-Kumar. He's the president of Sri-Kumar Global Strategies. Would you be lowering rates twice, 3 times, less than all of that?
I continue to say what I've been saying on your program, Andrew. No cut in interest rate at all going back. If anything, they should have been very careful in terms of hiking 1/4 percentage point. I was opposed to the September to December cuts, which took place last year. And I think they said at that time inflation has been conquered and employment is the thing. It keeps rolling, but they never seem to be able to make up their minds. Even this time around, with the minutes being released yesterday, they said they were very cautious on inflation.
Right.
They worry about inflation. Why then were all 12 voting members cut interest rates by 1/4 percent with only 1%?
It sounds like they are trying to balance the stability and inflation story versus the employment story, right? I mean, they are putting more focus on the employment story.
They are, but again, that balance doesn't make sense to me. You have one instrument called moving interest rate up and down. With that, you can only control one target. You have to decide what you're going to control. And if you decide today to control inflation, tomorrow to control employment, and you switch between the two of them.
This has been the great conundrum of having a dual mandate for as long as we can remember.
The dual mandate is an inconsistency. And you need to have, the European Central Bank says it has only one objective, inflation. The Federal Reserve says it has 2, and it doesn't achieve either of them. And now, keep in mind, they also wanted to tack on climate control and others. And as the Treasury Secretary now is interviewing candidates, he wants to make sure how the mission creep can be controlled. And I think that is a good point.
Mission creep, but not when it comes to the dual mandate. I think this administration is very much focused on trying to make sure the economy blooms and that the unemployment rate does not go up. But
he is, Becky, that's very true. They are concerned about the economy weakening and preventing that from happening. That is the president's intention. But the Treasury Secretary, on the other hand, is trying to make sure that the balance sheet increase the Fed has had is reversed. So they have 2 objectives which are going to run divergent to each other. So if the Fed actually follows what Scott Bessent says, and if they do go ahead and force the Fed to control the balance sheet, that's going to have a negative impact on the economy.
Yeah.
Even if you cut interest rates.
Okay, so let me ask you just a slightly different question. You are arguing that we have a very strong economy, I imagine.
We are having a strong economy on the growth number, but employment is not following that.
Right, so my question to you is, how strong is the economy really? Because, you have Jensen on the broadcast, and if you look at the AI piece of it, which I believe is not artificially supporting, but is supporting a huge portion of the economy right now. But if you X out all of the AI spending, you've got a problem, like a real problem. And so the question is, how sustainable, how long do you believe this AI boom goes on for? What does that look like? And if you don't believe that it's sustainable, or you think that there could be a hiccup along the way, given that it's so concentrated, even though it'll spread out into the rest of the economy, then you start to worry.
Yep. There are several parts to your question, Andrew. Let me take each one of them. These kinds of booms never last, starting with the Dutch tulip boom in 1634, lasted for 3 years before it crashed.
Yep.
The price of tulips increased multiple times when people said, what's the value of it? Similarly, AI is going to be a huge, huge phenomenon for us, our children, our grandchildren. On the other hand, what is going to happen is that there are going to be lots of failures on the way as well. Not all the firms are going to do well. So I think AI, you have a lot of promise, and equally you have a lot of hype added into it. So that is, I think, the first issue. Once that breaks, and when will it break? I'll just throw a date like 6 months from now, that you have a few of them few of the companies which do not succeed on the AI side. And if that happens, it is going to have a stock market-wide impact. And as well as look at the economy, the AI-related economy is doing fabulously. Non-AI economy is not doing well.
Correct.
And
which therefore raises a separate question about sort of inflationary fears, but also the unemployment piece that I think maybe the Fed might even be worried about.
The Fed should be worried about, but if you go back and look at the Powell speech in Rhode Island in late September, he talked about the difficulty he's facing with stagflation. He never used that word, but it's very clear from the speech that is what is bothering him. Weak economy and inflation still headed upward.
Right.
Keep in mind you have a 2% inflation target and you're running at 3%. And yesterday we had the New York Fed survey of consumers. Over the next year, they have hiked up their inflation expectation from 3.2% to 3.4%. It doesn't seem to me that the Fed is meeting its inflation mandate.
You think it shouldn't have two mandates?
It should not have two mandates.
It should have the one dollar stability mandate.
The dollar stability would be a derivative. You don't look for a dollar stability if you maintain good, orderly monetary policy with a rule.
What's the mandate then?
The mandate is going to be, your mandate, meaning the Fed, is going to be maintaining low and stable inflation rate.
Well, that's what I mean, dollar stability.
But if you do that, a stable dollar will follow from it, is what I'm saying. You don't need to target it separately.
Right.
But growth will
I just meant employment or inflation.
The employment has to be done by the U.S. Treasury. That is what they're there for. So why don't you each one have one target and you can do your job better?